Welcome to Taking Stock for the week ending the 10th of December 2021, with Jason Yin, our Senior Equities Analyst, and myself, Kien, Trinh, stream to you all things share market. Welcome, Jason. It's been a while since you've been on this video.
Thanks for the invite back, Kien.
Well, the Australian market has bounced back from concerns that the new COVID variant, Omicron, could disrupt the global economic recovery. But last week, we reminded investors to separate the facts from the noise. And the fact is, over time, COVID variants tend to be more contagious, but less deadly and more manageable. There is now emerging evidence to suggest that vaccines, especially booster shots, which increases antibodies by 25 times, can act as an effective barrier in preventing severe illness and death. The reason for this is because our immune cells can still recognize 80% of the variant spike protein. And this is why it's important for us not to follow the herd, invest in the facts, and treat investor fear and volatility as opportunity.
Yeah, and there was another round of volatility this week as the Chinese developer Evergrande defaulted on its US dollar bond payments for the first time. This latest action has been in motion for the past couple of months and paves the way for a massive restructuring for the world's most indebted developer. The Chinese government appears to have taken control of the company, and Beijing seeking to orchestrate a soft landing and maintain stability within the financial system. Fortunately, though, the iron ore price has recovered somewhat this week after customs data showed that China's iron ore imports rose 15% in November from a month earlier, and they're now at their highest level since July 2020. This should bode well for some of our star income stocks, including BHP, Rio Tinto, and Fortescue Metals. These companies continue to generate strong free cash flow, which helps support their above-market dividend yield.
Yes, Jason, and although a lot of the market volatility has been driven by global events, it's important for us to focus on the issues impacting our star stocks. Our portfolios have large exposures to the retailers because they have been very profitable during COVID, and that's on the back of stimulus checks by the government. But investors have been questioning whether this profitability can be maintained. Now, the chart on screen compares the rate of household consumption as indicated by the black line with a leading indicator called credit card purchases and cash withdrawals in red. As you can see, although the trend in household consumption has dropped slightly, credit card purchases have begun to recover. And this is not surprising given that we're heading into the busy Christmas period.
And this could be a positive sign for our retailers as well, Kien, especially those with a large retail portfolio, as footprint across Australian shopping centres should lift during this festive season. In fact, we've seen Premier Investments, which is the owner of Smiggles and Peter Alexander, report a 12% rise in like-for-like sales over the financial year to date. Now, even though sales growth is expected to be negative in FY22, as due to the impact of the government restrictions, consensus forecast earnings have been positive, and this may suggest a trough in the market's negative earnings growth forecasts.
And during the week, Jace, we introduced a new company into our Lincoln Star Stock universe, Gold Road Resources. The company is a mid-tier gold miner which owns a 50% stake in Gruyere Gold Mine in Western Australia. The mine is a Tier 1 asset, which essentially means that it has a long service life of greater than 10 years and has low production costs. Investors may be wondering why we have included the stock in our Star Growth Stock universe, even though under Golden Rule 3, the outlook and active risks does not look too appealing. Well, the negative earnings revisions of around minus 27% was the result of operational issues in early October, which led to a downgrade to the financial year 21 production forecast. However, since the result, the company has announced an upgrade to its Gruyere ore reserves, extending the mine life by another 2 years.
Well, looking ahead, Kien, we feel the operational issues at Gruyere are temporary, and management is forecasting production volumes to reach at least 350,000 ounces per annum by 2023. Current consensus estimates also point to a healthy recovery in FY22, with earnings per share growth of around 170%. As such, the risk to reward equation is now more balanced at these prices compared to those in November. Another company to enter Lincoln's Star Growth universe was building products manufacturer CSR. We identified several near-term earnings tailwinds, including the strong demand for Australian housing construction persisting into second half 22, the low interest rate environment that has made it easier for borrowers to obtain funding, and the federal government's home builder scheme. These factors should help deliver double-digit earnings growth over the next 2 years.
Now, some members may question why CSR is not a star income stock, given that it trades at an attractive gross dividend yield of over 6%. And the reason is due to the volatility in financial year 22 free cash flows, which are projected to be lower from the previous year. Higher working capital requirements are anticipated in the second half 22, and this is expected to put pressure on dividends. The shortfall creates uncertainty around how the company will fund its future dividend payments.
All right, turning our attention to the corporate calendar now. News flow is pretty light for the week ahead, with only ANZ, Westpac, and NAB hosting their AGMs. For the technically minded investors out there, you can use the SD Max, which is the Stock Doctor moving average crossover, or the SD30 TSR, which is a 30% stop loss or gain from its recent highs and lows. For the highly trend sensitive investors, though, Commonwealth Bank, Macmillan Shakespeare, MyState has turned bearish on the SD Max this week. Meanwhile, we did receive bullish signals for Sandfire and Fortescue Metals. There have been no changes in the SD30 TSR.
A good study for Under the Microscope this week is ex-star stock Magellan Financial Group, a global fund manager which has been plagued by problems in recent days, including the sudden departure of its CEO, Brett Kien, continued fund outflows, and confirmation that the chairman and founder, Hamish Douglass, has separated from his wife. With global fund managers, it's important that key personnel are retained and are not distracted by major personal issues. Positively for us though, and our members, we removed the stock from coverage in August on both quantitative and qualitative assessments. Not only did profit margins fall from 68 to 59%, but the company was also marred by significant underperformance, which forced Magellan to move from monthly fund flow reporting to quarterly reporting. In addition, we had heightened regulatory risks for Chinese technology and education stocks, and that didn't really help given that 13% of the group's portfolios were exposed to the Chinese market.
Yeah, it's also interesting as well, Kien, that Magellan shares a very similar investment style to Lincoln, which is to invest in high quality growth companies. Unfortunately for Magellan, though, their strategies have lagged the market, and its global equities fund over the past year has underperformed the MSCI World benchmark by around 15%. Look, don't get me wrong, the group has captured the spectacular rise of US tech stocks since 2019, but its success could also be its Achilles heel, and they may have grown too large to stay nimble. Over the past financial year, our Lincoln strategies faced similar headwinds, and our portfolios were caught out on the wrong side of the trade during the last style rotation. But instead of clutching to our egos and hoping that things will work out, we embraced the changing environment and adapted our stock selection process to the new COVID normal. This pivot saw a recovery in the performance of our star growth portfolios across all timeframes.
And for investors, Magellan may look attractive from a value and dividend yield perspective, but we remain out of the stock for now. The gross dividend yield of around 10% has been inflated by the recent share price fall rather than earnings momentum, as alluded to by the negative earnings revisions under Golden Rule 3. The active risks around the management team remain high, and this has led to a rise in short interest on the stock. Those looking for exposure in this space may want to consider our Australian and US Lincoln managed funds. Otherwise, if you prefer to manage your own investments, you can consider some of our star stocks. There's Pinnacle Investment Management, Perpetual, or even the ASX, the Australian Stock Exchange. Earlier, we spoke about excluding building products company CSR from our star income universe, despite its seemingly attractive dividend yield. We also provided a case study on why we believe Magellan Financial Group is a yield trap. So a useful question for investors this week is, how do we assess whether the forecast dividend yield on a stock is sustainable?
Yeah, and that's a very good question, Kien. Dividends are typically paid out of cash to shareholders, so it is therefore important for us to look at a company's ability to generate that cash. For industrial and resources company, we look at the trend in free cash flow, which is defined as the net cash flow from operations less any capital expenditure. We tend to prefer free cash flow trend that is either stable or rising. More importantly, though, we want to see dividend payments that can be fully covered by free cash flow. Unfortunately, in the case of CSR, free cash flow has been in decline and is expected to be lower than future dividend payments. Therefore, there is a risk that dividends could be cut unless forecast cash flows improve.
We need to really be careful here, Jace. Declining free cash flow may not necessarily mean that a dividend is at risk of a cut. A company could be making an abnormal investment to generate stronger cash flows into the future, and they could also have ample cash on their balance sheet to help sustain the dividends in the near term. This is where a qualitative assessment is crucial in understanding yield sustainability. And part of our qualitative assessment is to also investigate whether capital raisings and or debts are used to pay dividends. Assessing the active risk to the business earnings outlook under Golden Rule 3 is also important. And this includes, for instance, looking at the trend in the 3-month earnings revisions.
For defensive sectors like infrastructure, utilities, and REITs, free cash flow is not really a useful measure because these companies tend to have very high capital expenditure, which can translate into negative free cash flow. So for these sectors, we look at and assess the operating cash flow because we believe this is more reliable. Say in the case of REITs, operating cash flow is effectively the rental income it receives, and REITs tend to pay out most of its rental income in dividends. For the financial sectors, however, cash flow figures are also not useful in assessing dividend sustainability because they include cash from third parties such as customer deposits and loans. So for financials, we look at the trend in earnings per share and compare this to dividends per share. Other factors investors can look out for include the trend in the payout ratio over time, the trend in dividends per share, and the attractiveness of the dividend yield. But we have to be careful here because the high dividend yield, like you suggested, Kien, could represent a yield trap, especially if the share price has depreciated significantly, like the case of Magellan.
Yes, Jace, a track record of dividend payments is also quite important. But just to remind investors, yield traps are companies that display attractive yields but are likely to cut dividends in the near future on the back of heightened active risk to its outlook. Thanks, Jace. Great to have you on board again.
Thanks for having me, Kien.
So a reminder that we have updated our white papers and educational videos, which are available in the Resource Centre. And also next week's Taking Stock will be the last one for the calendar year before we start again next year in February. But the key messages for today: markets will always face macroeconomic risks. It's up to us to investigate these risks and separate the facts from the noise, because understanding the facts creates opportunity. And if your investment strategy or your stock investment is not working out, do not wait and hope. Try to understand the weaknesses in your approach and learn from it. Innovate and adapt. Stay safe and have a happy, healthy, and prosperous week ahead.